Investing for a long period of time is something that I promote often on this channel. If you're curious why, there are quite a few videos on this. Take your pick. But the question I want to look at today is, when does an investor begin to consider changing their portfolio to invest for the short term or in a different strategy than long-term investing? Let's look at the data. Investing for periods of time that are 10 years or more have returned well in most periods of the stock market. Here's a picture from the Wealth of Common Sense blog. On the x-axis, you can see the different years of the stock market and if you had invested in them. On the y-axis is the annualized return from those years if you held on to the investment looking forward. The first thing to note here is that there's a lot more green than there's red. The second thing is that the red stops after about the 10th year. So if you had invested in any of those years and held on for 10 years or more, you would have made money. The third thing to note is that after about the 18-year mark, most of the annualized returns find their average with about an 8 to 11% return. This long-term return is the case for the long-term investor. Even if you're 60, you'll likely live for another 18 years. But as soon as someone starts to need their investments to live off of for a purpose that is earmarked in the short term, such as a car purchase, funding education, or anything that they know is coming soon, there's a new problem that arises. That problem has a fancy name called a succession of return risk. This is the risk that the market drops when you need access to your investments. For an example, say I had invested $10,000 in hopes of paying for a vehicle whenever the balance reached $11,000. That's only a 10% return, which is close to the market's annual average. But if I had invested at the wrong time, it could take me 7 years until I reached $11,000. God forbid I needed the car sooner and had to sell the investment when that investment reached $5,500 in the second year. The risk that I had to sell the investment in the short term is the risk of a bad succession of returns. If the stock market went up 10% per year every year, we wouldn't have to worry about that problem. But unfortunately, that is not the case. So here are a few times that it might make sense to worry about changing your investment strategy. Number 1, a major life change. This could take place in many different stages of life, but each one will have a different outcome or requirement for an investor. The easiest one to think of is nearing retirement. If you're nearing retirement, that is a massive life change and a huge potential change to your portfolio, which switches the portfolio from being growth-oriented to providing income for daily living needs and wants. Other life changes include, but are not limited to, changing jobs, reaching financial independence, having more invested than you need, losing a job, earning a high-paying job, adding liabilities or debt, and the list can probably continue to go on. Each time that these major life events happen, it's worth asking yourself, does this change my risk of my investment portfolio? Can I increase risk, or should I decrease risk because of this change? A great example of this could be one that most people don't implement or even consider. If someone is 80 or 90 years old and has significant assets, they likely have more than they need for themselves. So there's an argument that a lot of money is not actually for them, but rather for their children or their beneficiaries, and could beckon a longer-term investment strategy instead of a conservative investment strategy. That is, of course, if the individual has the risk tolerance for those type of investments. And that leads me to my second reason for making changes to your portfolio. Number 2, your risk tolerance and/or risk capacity has changed. These are tricky terms, so let's define them. Risk tolerance is the ability to watch your investments fluctuate without making any major changes because of your emotions towards them. You would know if you have a high risk tolerance when the market sells off and it doesn't really bother you, or if you haven't made investment changes in the past sell-offs. If you have a lower risk tolerance than you might expect. Risk capacity is the ability to take risks and it doesn't impact your needs for living. For example, if someone worth $3 million invests $1,000 in a risky venture, it probably won't positively or negatively impact their life if it drops by 50%. However, if someone who only has $1,000 invests all of it, they would be greatly impacted if it drops by 50%. Realizing where you lie on the spectrum of risk tolerance and risk capacity is massively important in an investing career. If your portfolio is out of line on one of these, it could have a big impact on your finances. For example, say someone thinks that they have a high risk tolerance, so they invest fully in the stock market, but then the market goes down by 20% and they sell because they're scared. This could have a massive impact on their long-term returns and retirement if they don't get back into the market at the right time. This investor would have been much better off taking less risk at the start so that they don't sell when the market goes down. Or in another example, if someone is retiring, the risk capacity goes down. Instead of the portfolio sitting on the sidelines, it will soon provide most of their needs for their living. If the portfolio drops significantly, it could cause a massive lifestyle change for them moving forward. Because of this change in risk capacity, they might need to make a portfolio change. The third reason you might need to make a change is if you know that you have short-term needs that are coming up and you're going to have to pay for them. If all of your money is invested in the market, you might be unprepared for life emergencies or for bigger purchases that are just a part of regular living. This is the case for emergency funds, as well as saving for bigger purchases on top of your emergency funds. Finding a healthy mixture of risky assets and less risky investments can be a hard balance, but hopefully you can find what works for you. Tell me in the comments, what other times have you made changes to your financial plan? Did you expect to make those changes, or were they a surprise? Let me know below. And after you do that, check out my video on 3 ways to combat losing money in the stock market.